What's going on, dividend chasers? Dividend Bloodhound here with another investing episode. In this episode we're looking at if the FTSE 100 company, the AA, is a stock to add to your portfolio in terms of dividend growth, dividend yield and share price growth or not. It's as simple as that really. If this video does bring you some value, that'd be great if you could hit the like button in the corner over here, or if you're brand new here and want to see more content just like this, then do please hit that subscribe button and even tick that notification bell as well, and then you'll get notified when I release content like that. That being said, let's roll the intro and let's get in there. Catch you on the other side. Hello again guys, welcome into the video. So in this episode we're talking about the AA, which is obviously part of the FTSE 100 and the UK investing scene, often styled as the fourth emergency services once upon a time, and it is actually a company with quite a high revenue, been around for a very long time, big yellow vans, big black letters on saying AA. Everybody knows who this company is. They have over 3 million members across the whole of the UK paying into their, obviously it's almost like a subscription service, and they've got 2,900 patrol vans out all the time, responding to roughly 10,000 breakdowns every single day. They also operate a driving school, insurance places, insurance policies, driving technologies. All of these things add to what is their quite big revenue stream. What's so interesting about the AA at the moment is that they've been approached by numerous companies for acquisition and almost merger purposes, and the next company to throw its hat into the ring is the American investment company Apollo, which has been known to take over and invest and merge with companies and help bring them better on and make them better companies in the market. And that is no exception with the AA. The AA has got a significant debt burden at the moment, and Apollo have come up with a £3 billion takeover bid, essentially to buy the AA, assume that debt, reduce it, take it to a lower level, because it's all due for payment in the next 2 years or so. So it's all due, whoever they borrowed the money off wants that money back, and Apollo's coming in and saying, well, we can take on that debt at a much lower rate and we can make AA a more profitable business going forward. Now, Apollo is not alone in the takeover bid. There's also other companies such as Centrebridge Partners, Towerbrook Capital and Platinum Equity. They all have similar and rival bids going in to take over the running of the AA, and they're all looking to get in, or at least Apollo is looking to get in at about 40 to 50 pence a share, give or take, with approval from the AA board, of course. Now, that has actually caused quite a big spike in the share price just recently, and it has gone almost sailing upwards like a little rocket and put about 10 pence on the share price based on this news. And the share price was approximately about 22 pence a share, and it's now 32 to 33p, and it could go further north than that as people start to realise that there's some money to be made in this company post takeover, which is always, when the traders get involved, a place that a lot of people can make a lot of money. That being said, let's actually get into the app and let's actually have a look at the fundamentals of this company, where it started, and then talk a little bit more about what's going to go on with the company going forward. What's going on again, guys? Welcome into the app, and here we can see the decline that has been AA's share price over the years. If we look all the way back to 2015, once upon a time they were £4.16 a share, and now today, even with the recent uptick, they are 33 pence a share. What a decline that has been, 86%. However, if we look in the recent days, there you can see the uptick that I've mentioned since this headline broke, and they went from okie dokie, they went from 30p to 33p just before the market closed. So not quite such a such a dramatic 10 pence increase that I was talking about, but still, based on if you bought 10, 20, 30 shares, definitely some money still to be made there. And then we have another headline there being made as well, early August, even earlier in August, should I say. Now, the fundamentals, if you take the debt out of it, aren't actually too bad. So the ticker is obviously AA. They have a market cap of 148 million, a PE ratio of 1.74, yet they have a revenue of 993 million. That is vastly superior to the market cap. But the reason the market cap is so low, obviously, is because of the significant debt burden this company has. That being said, they have an EPS of 14p, and they still have a decent dividend of 2.51%, which is actually not too bad, and is just shy of the golden area for me. I'd prefer a 3% plus yield, between 3 and 6%, so it's just shy of that, but with no tax against it because it's UK based. That wouldn't be so bad at all, and they've actually decided to maintain the dividend and reward shareholders, as well as trying to pay down the debt in another way. Some might argue that it would have been best for them to cut the dividend while they pay the debt, but if that happened, they could lose some of the loyal shareholders, and that would take a further chunk of what's left of the share price, and there really isn't that much left of that. That being said, you can see the revenue over the last few years was declining until 2019, and now has ticked up so far in 2020. The net income, should I say, not revenue. Revenue has grown steadily. Net income is now at 87 million. Then the big one for most people will be the debt to assets ratio here of 182%. For most people, that's a massive red flag and a big no-no. This company is only for a certain amount of people and a certain type of person. Now, if we slide across to the revenue growth rates, we'll see that it isn't actually especially great either, to be fair. The last 3 years, revenue has grown only 0.22%, and growth over 5 years only 1.91%. Now, that's not spectacular, but also growth is growth, even at a small rate at that. It's better than a shrinking company. And then if we have a look at the earnings per share there, it is actually slightly better and slightly better news, which means they're a little bit more efficient. Compound annual growth rate is actually in the negative, not by much, but definitely negative. That's also not a great thing, but that is also due to the significant debt burden the company has. As you can see there, the 3-year dividend growth is in reverse, cut by 60%. So this is definitely not a dividend growth company. You're going to make the money on this company through share price growth, not really through the dividend, I would say. But the yield is still 2.5%, which isn't bad, but it's not great. But I wouldn't expect that to grow particularly quickly if I was going to invest in this company. So overall, there is some potential money to be made in this company. You do need to have the stomach for the risk, and you need to wait out the acquisition, which acquisition firm wins out, and what price they're going to pay per share. But there is certainly a little margin in there for you. That being said, I'm going to wrap it up there, and I'll see you back out in the outside world. Hello again, guys, welcome back to the real world. That was the AA there, Britain's 4th emergency service, apparently. I believe this company has got some growth and some money making potential. Will I buy it for my portfolio? Not exactly sure, to be fair, but a lot of people will see that there's a margin to be made along this acquisition that could give you a nice little return. If you got in at your 30p and they pay the higher amount towards 50p a share, there is definitely some sort of margin to be made in that if you get in quick. But I could see the share price spiking to about 45p a share pretty quickly, and then your margin is just non-existent at that point. There is certainly a good potential, if you can get in quick, good potential to make a quick buck on this one. I might decide to stick myself in a few quid, but nothing that's going to break the bank in any way, shape or form, which would mean I wouldn't make life-changing money, but I would still make some money. So it's definitely worth looking into at the very least, and just taking acknowledgement of the share price at the moment and the acquisition that's happening. The one big thing for this company in the long term is they obviously deal in breakdowns, and with cars tending to go electric from, well, we're already on the curve of everybody replacing their cars with electric alternatives, but that process is only going to get quicker and quicker, and there's a hell of a lot of stuff that will be less wrong with electric cars. There's no engine, so there's less things that can go wrong with it. Essentially, for the most part, it will just be software or the battery or the motor that drives the wheels. There can't be that much wrong with it, and that could have an impact on AA in the market and just how many members they get. That is a long-term thing. I'm not this video is more on about making the money in the short-term acquisition side of things. If you were to hold this company for the dividend, hopefully some longer-term appreciation, this would definitely be something to consider, that the trend is going towards electric, and a lot of people might not necessarily need the breakdown cover to go along with that. Maybe the recovery services though, who knows. There's also worth noting that there's other companies in the market. AA is not alone in its recovery and breakdown cover. There's also RAC, Green Flag and other smaller subsidiaries that are trying to weigh in and steal market share, and that, along with the electrification of the UK car market, is going to squeeze AA's profit in the longer term. That's not something to think about right now if you're just trying to turn this one round for a quick profit. The other big risk, as I've already mentioned, is that super high debt burden in the short to medium term. But that almost gets wiped out by this acquisition. If you can come in, make yourself 10 pence a share, if you manage to do that over 100 or 1,000 shares or whatever, you're pretty quids in. That being said, I think I've talked long enough about this company now. I hope you've enjoyed the video. I'm going to wrap things up there and just say, if this video has brought you some value, it'd be great if you could hit the like button in that corner there. And if you've never been on this channel before and would like to see more of my content, do please hit the subscribe button and the notification bell as well. That'd be absolutely fantastic. This video has been a pleasure to make. It's been great to research it. Hopefully I'll see you in my very next investing episode. Catch you later. Bye bye.